you buy into or, think about, or, worry about, or, how much it plays into your thoughts around the federal government and the spending that they're doing and how their debt's rolling over as well. I mean, you think that matters at all to the Fed, or are they like, because I mean, at the end of the day, like interest expense on our national debt is going to go sky high to levels we've never seen, especially as a percentage of GDP, but even just on a nominal basis. And so, does that matter at all too? I mean, like, is there a scenario where we're looking at refinancing all this national debt? We're looking at an election coming up. Does this like move the Fed's hand in terms of either pausing permanently or cutting it all? Or does that stuff just kind of white noise and it's more kind of macro fairy tale stuff that you don't pay attention to?
Well, I mean, I think it depends on the interaction of the dollar as that plays out, right? Sort of the argument is that we can keep on leveraging up as long as we're the reserve currency. So the moment you're not a reserve currency, or at least that status is questioned, you can argue that's happening at the margin. Then it becomes really problematic because, then it's like the Japan situation that you saw last year, right? Where you've got high inflation, collapsing yen, a lot of volatility. Now, it ended up working fine for them because they did yield curve control and they've got inflation, and now their markets look like they want to push higher. I have some doubts on that. But it becomes a problem when it becomes a problem, right? It goes back to this point that we all know the debt is awful. We know the market knows the debt is awful. The government can keep on rolling over the incremental new debt, right? Because obviously it's different maturities, right, on where the liabilities hold. None of this, by the way, factors in all the unfunded liabilities, right, which, depending upon some estimates, are like north of 100 trillion. So, like, all this does have to factor into the Fed's thinking very, very long term, which is why they will never get out of the balance sheet game. But they still have to try to at least show a good faith effort to break inflation, which means they have to somewhat at the margin break the economy, but not too much.
Right. Pivoting back to the bond side, talk about the yield curve currently, your bonds, the bonds that you hedge within your funds, and just, I mean, I'm not in that market day to day. I don't watch it as much, but just your thoughts on what bonds have been doing, how that plays in with your strategy this year versus last year, just kind of riff on bonds.
Yeah. And it's important distinction between bonds for yield, buy and hold, and then treasuries for relative safety when you need it the most. Right. Which again didn't happen last year. It's like I keep going back to all these narratives around what happened last year are very surface level. So a lot of people said last year stocks and bonds are due to fall. No disagreements. That doesn't tell me anything about how they fall, the interaction, how volatility plays into that sequence, right? Which is, I think, often missed by a lot of people. You mentioned Luke Roman. Luke Roman references that top 20 drawdown chart quite a bit in the podcast that I put out, in his podcast that he interviews on. But the point here is that what failed last year wasn't bonds so much as it was the flight to safety dynamic, where you end up having stock market volatility rising. Stock market volatility rising means default risk premiums are rising, credit spreads widen. There becomes a feeling that we're in a period of economic uncertainty. So what does money do? It goes into the pristine asset long duration treasuries, right? Now, that failed miserably last year. That's why my funds got so hit. And rules-based, again, means independent of my opinion. If I die tomorrow, runs the same way. I couldn't do anything about it. I called last year hell because I could see the treasuries were failing, and I couldn't do anything about it. And that's the nature of being somebody who has a prospectus, which is effectively a contract, right, with shareholders. Now, this year is interesting because you saw the return to the flight to safety trade for a brief moment in time as the regional bank crisis was playing out mid-March. In other words, you saw regional banks collapsing, a lot of equity volatility. Everyone says, we're having to run the banks. And you actually saw long-duration treasuries, TLT, as a proxy. That price rose, yields were dropping. So there was that, for a moment in time, a flight to safety type of sequence, but it only lasted for like 2-3 weeks. And then you kind of went back to the playbook of old with treasuries selling off and actually equities, for the most part, doing okay, at least on the large cap side. That may be the first sign that the dynamic is back, but you need to have a little bit more persistent pain, right, to have it really actionable for traders and investors, right, kind of using treasuries as your expression of being negative on equities. So I think if you're going to think about bonds here, you want to think about high quality. If you're going to be a buy and hold investor, you want to think about trading when it comes to long duration treasuries. Again, I'm biased. I want to see that. And I think you want to be patient for whenever junk debt really starts to have severe distress. right? Because if you get credit spreads widening, there's going to be an opportunity for some of these junk debt issuances to be scooped up at like, 10, 15% type yields, because your starting level is so much higher than it was last year. And now you have an overreaction on the likelihood of companies going belly up. So there's going to be an opportunity to really, I think, buy low when it comes to really junk areas of the marketplace. But it's like the definition of profanity. You'll know it when you hear it. You'll know it when you see it. You're not there yet. So it's better to hide out in quality and then be ready to pounce when, it looks like there's a crisis in the bond market.